Hey everybody, it's Austin at Homeowners Financial, and we're getting so much talk about buy downs, temporary buy downs, permanent buy downs, all the buy downs. How does this work? So I wanted to create this video really to focus on temporary buy downs. Now, we're not talking about adjustable loans. We're not talking about permanent buy downs. Permanent buy downs are when you're buying points towards your loan. We're talking about temporary buy downs. So I'm going to share my screen. Let's do a little nerdiness. Let's do some stuff. And let's get again on what these are and whether or not they actually make sense for you, right? So, temporary buy downs, what are we talking about for these, right? Really, what's the whole concept and how do you get these to go? Now, temporary buy downs are eligible on only on certain products. Conventional loans, so these are conforming loans, right? Fannie Mae, Freddie Mac. It's a 3-2-1 buy down, it's a 2-1 buy down, it's a 1 buy down. It's available on all types of loans from high balance and super conforming, right? Now, super conforming is Freddie Mac's version. High balance is what Fannie Mae calls it. And that's when we go over about the standard loan limit, which is a whopping 647,200. So every county in the nation has its own high balance and super conforming loan limit, but everywhere across the nation gets 647,200. So that's conventional. Could be a 3, could be 2, could be a 1. Government. Now, government does not have that 3 option. FHA and VA, they allow both the 2-1 and a 1-1-1-0 buy down. This is available on high balance. Again, when we're going over that county limit, 647,200, we're above that amount and it's still eligible to be VA, county by county. Let me know if we need that info. And then jumbo loans, there's a 2-1 buy down or it's a 1-1 buy down. So that's where we can do these. Where we can't do these are conventional loans that are like Home Ready, Home Possible. Those are those low to moderate income down payment assistance type transactions, renovation loans, ARM loans, down payment assistance, those DBAs, DPAs, government loans. Government loans don't, again, have the 3-2-1. They aren't allowed in renovation. They aren't allowed on ARMs, and they aren't allowed on DPAs. It's also really important to note that we're talking really about primary residences. Primary residence investment completely off the table. There are some options for second homes, but we're really talking about primary residence. So, will you live there? So let's talk about how this works. Now, look, this is a lot of math, y'all. It's a lot of math. So I wanted to make this really as digestible as possible. So I took the max you can deduct from a federal standpoint is $750,000. I'm like, let's just use that, and let's use a rate of 7%. Or rates at 7% today. For some people they are, for some people they aren't. What does that mean? So let's just take a base rate. So on a 3-2-1 buy down, the way that this works is you're paying as if your rate was 4% the first year, as if your rate was 5% the next year, and as if it was 6% in year 3. So a 3-2-1 buy down encompasses 3 years, and it's going to shift back up to that 7% in year 4. The way that this is done is by a subsidy, right? This isn't points that you're paying on the transaction. You may have points as well, that this is a subsidy, right? Where the seller is, or builder, but typically the seller is contributing towards your closing costs, contributing towards the buy down costs. So in our example, when we're going for a 750 loan amount and we're saying today's rate 7%, if we did a 3-2-1 buy down, that means the buy down cost is $34,000. That's a big number, right? Conversely, if we did a 2-1 buy down, we know that the 7% is where that final is. That's where your true interest rate is going to be. But that first year you pay as if it's 5%, and then that second year as if it's 6%. Again, it's the subsidy with 2% less that we're starting in year 1, 1% year 2, and then moving back to the actual rate. And that would only cost just over $17,000 in this scenario. Say only like 17,000, just coming out of thin air. And then there's a 1-0 buy down. That's really just supplementing that first year. So you can see in each one of these scenarios the difference in the payment. Again, going back to that 3-2-1 buy down, if we had our regular mortgage payment today, it would be $4,989.77. But that year 1, if they bought that down to that 4%, you'd be paying 3580.61. If we did it on a 2-1 buy down or just a 2 difference below our actual interest rate, we're looking at $4,026.16, right? So you can see what a payment differential that is for you as a buyer. So there's some pros and cons to this. And so I wanted to dig in it, right? Because it doesn't work for everybody. So pros is that this is still a long-term fixed rate. You don't ever have to refinance this if you don't want to, right? The loan will never ever adjust, right? But it's really fixed for the long term. Now, the other pro, which I think is just fan freaking tabulous, is that any money that's not used towards a subsidy or applied towards the principal at refinance. I'm going to say that again. If they didn't use the money towards the subsidy, it's applied towards the principal at refinance. So let's back that truck up for a slide, right? What the heck does that mean, Austin? So here in our example, let's look at this 2-1 buy down. We can see that in year one, the subsidy was $11,563.28. We can see year two, the subsidy was $5,917.68. So let's say you refinanced at the end of year one, like just magic calendar perfect right at the end of year one. That means there's $5,917 that's still in this bucket of subsidy that was paid for by your seller that would then be applied towards your principal. Boom. That's a game changer for me. That's absolutely a game changer, right? So any funds that are not used towards the subsidy are applied to the principal at refinance. Now, the con is that the seller has to participate. So some people are adjusting sales prices like, hey, seller, instead of taking a reduction of $34,000 and, adjusting your price down, let's just do this to entice buyers instead. Or hey, seller, let's negotiate different credits that we may have through escrow. The seller does have to participate in this. The con is that you still qualify on today's rate. So you're not qualifying as if your rate's 4% or if it's 5% or if it's 6%. You're qualifying at that actual 7%. And that can be detrimental for some people. But I think the reality in this market is that we've got to recognize that rates will come down at some point in time. What we're using these for is to really offset this payment shock that a lot of buyers have had. Prices, I don't really see prices dropping drastically in our 805 market. I think every market's going to be different. So if you want to know more, reach out to me. Let me know. I'm Austin Lamson with Homeowners Financial. You can contact me, Austin at austinlamson.com, A Lamson at Homeowners FG. Either one, they go to the same spot. My website is austinlamson.com. So thank you for watching this YouTube little video. I hope you have an amazing night and let me know what I can do to help you or anyone else. We're all in it together and let's go take advantage of some opportunities. Talk to you soon. Bye.